right. So what we're talking about right now, I think, is critical. As you and I record this podcast, market valuations are really at all-time highs. Okay, so I want to take a step back in history and just kind of set the stage for what I think is something that is critical. And you and I were talking before we started the podcast here that what we're going to share right now should keep people up at night. And then you said, Dean, there's a lot of things that should be keeping people up at night right now. And we can talk about some of those things. But we go back to the 1929 market crash and what caused it, right? We had extreme overvaluation. We had the roaring 20s, which sent valuations into the stratosphere from what was a normal valuation of the market. And we had a lot of leverage. In other words, there was a lot of buying on margin. And for people that don't understand what happens when you buy on margin, you can lose more than you have invested, right? So when people say they lost the shirt off their back in their house and everything else, they did because they margined. They could borrow at that point in time against virtually anything and invest that money in the market, okay? That was what exacerbated the Great Depression. We fast forward to 1997, and we were in the heat of the dot-com bubble. And in 1997, I believe, was the year that Alan Greenspan uttered the term irrational exuberance. And what he was talking about and referring to was that valuations for the first time since the 1929 market crash had eclipsed that same level of valuation. And you know the story, but valuations kept going up and going up and going up and going up until it almost doubled what the valuations were before the 1929 market crash. And then the dot-com bubble burst. And then we had 3 years of gut-wrenching bear markets that saw the markets down over 50%. Unless you were in the NASDAQ, it was over 70%. And it took over a decade. If somebody invested in January of 2000, and you were, I think, 12 to 13 years later before you actually got back to even if you just did a buy and hold in the index.
Right.
Horrific.
Right.
Now we find ourselves in 2021, just outside the COVID era, with valuations higher than they were during the dot-com bubble. And we have talk about inflation, right? We have talk about a second variant that may become even more strong in the winter. And what happens when we get inflation? And so, first of all, valuations are out of sight, okay? But that doesn't mean that a crash is coming tomorrow or the next day or even next month or even next year. Valuations can stay elevated for a very long period of time. But why I bring this up is because I think it's relevant that people actually understand what they own and what are the real risks, so that if this does happen and this thing unwinds like a dot-com bubble or like a Great Depression or a Great Recession, understand what is at risk, the dollars that are at risk, right? Because you can't spend average annual returns. You can only spend real money,
right?
And when this thing comes apart, and it's down and down and down, people need to understand. And I think that was one of the things that happened in 2000 and in the dot-com bubble, and then it repeated itself in 2008. Is that people that weren't our clients would come in and say, I don't understand how I lost this much. I had one of these lifestyle funds that was supposed to, I was going to retire in 2010, and I knew it. It says there's a retirement 2010 fund, and this thing down 35%. I can't retire in 2010 now. Right. Because they didn't understand what they owned. And I think today we're so far away from the people that really got hurt then that we have a setup for another scenario where people just don't understand what they own, and they just see their statements keep going up, and so they're getting greedy, and we're not going to make a change.
Yeah. So let's back up a little bit, because through everything that you said, there is similarities between today and what we saw in the 90s. You already mentioned one, valuations, right? If you looked across the 9 style box, which represents large cap stocks, small cap stocks, mid cap stocks, growth versus value, everything is showing that it's overvalued at this point in time. But guess what? It's showed overvalue for about 8-9 years now.
Right.
And so the question that is out there is how much longer can this go? And the problem is investors often get in these types of cycles and their expectations start to change. If you go back to the 80s and 90s, right? And especially in the 90s, man, it seemed like year after year, 20% returns out of equities. The expectation was the gravy train was here. I need to be on it.
Right.
And so what happened? Well, everybody started chasing those returns. And guess what? The biggest pocket of growth during that time frame was what? Large cap growth, the NASDAQ, the technology,
telecommunications.
And so you started seeing even managers leave their mandates and saying, I need some of that to be competitive and relative to help manage my value fund over on this side.
Right, because I'm going to get a 2-star rating from Morningstar versus a 4-star rating, and people aren't going to put their money in there. They're going to pull their money out. And so, yes, they play the game.
And the expectations of the investors is that they need to participate in a portion of that. And I will tell you, it led to one of the greatest periods of wealth erosion that we've ever seen, right? The 2000 through 2002. And it's because we saw this expectation, this greed, right, that was chasing the returns. They got overheated, and eventually markets are efficient. Right? Everybody wants to ignore that statement, but markets are efficient. And when the stars don't all align, then markets are going to price that out appropriately. We saw it in 2000, 2001, and 2002. We saw it in 2008. We saw it through the scare of global financial shutdown with COVID and last year. So I think this expectation that investors have is a dangerous notion for this go around. Because what we're seeing is, again, investors are chasing returns, and not just in equities. Let's use bonds as an example here as well.
Real estate as well?
Real estate. So let's use bonds for just a second, though, right? A good, stable core bond, like the Barclays U.S. Bond Ag, a 7 to 10 year duration, very conservative. All of a sudden, you're seeing everybody kind of ditch that core bond exposure. Why? Because they want more return. The expectation is there. I need to participate in this. So what do they go get invested in? Well, they're looking at credit opportunities, things like junk bonds, high yields, things like bank loans that have a better credit structure than junk bonds, but nonetheless, a credit exposure. And here's the problem with that, is you start to chase an asset class that is starting to become more correlated to your equity, your stock portion of the portfolio. We saw this in the late 1990s.
Well, it happened in 2020.
We saw it in 2020
COVID, right?
again. Yeah. And you get overextended, and all of a sudden, when equities start to crash, your ballast of protection in the portfolio is no longer as strong as it was before. So I think that this is a critical moment for people to at least be exploring and understanding the differences in an expectation net long-term market cycle versus what we've seen in the last 10 years. Similar thing could be said in the 80s and 90s. By the way, if you looked at a 120-year history of the Dow Jones, this massive movement wave of returns that happened in the 80s and 90s, that's not the normal.
No.
That's not the norm at all. You had huge economic expansion that took place that lifted everything up. And I challenge, if you just started investing thinking that's the norm and that's the expectation, similar to people that just started in the last 10 years, guess what? You could have a very rude awakening unless you're having conversations around risk to portfolios.
Starting your route to retirement.